Here is a video on the accounting equation. Let's pretend that this is you, and you're a pirate, and you're ready to get out of the piracy business and move into something more laid back and less dangerous. So you decide that you want to start farming. You don't have a lot of money from your high seas adventures, but you do have some. And so in order to start your farming business, you're going to need some more financing. You're going to need some more money. So as a pirate, you go to the pirate bank. You can borrow money from the bank and use that money to start your business. Unfortunately, you are going to have to pay that money back. And so we call that in accounting a liability. Money that you owe or a company owes other people. Once we've obtained all of the financing that we need, we're going to use that money to purchase the different items we need to run our farming business. So we're going to spend some of that money and we're going to buy a farm. We have to have a barn, silo, other things in order to be a farmer. We also have to have a tractor. And you cannot be a farmer without having a truck. So we have used the money that we obtained through our financing activities to acquire some assets. We have used the money to invest in assets that we need in order to run our business. We call these investing activities. Now, once we've acquired the assets that we need in order to run our farm, then we can operate our farm, our business. So financing activities, investing activities, and operating activities. You're going to see these again throughout accounting. If we took all the assets that we have and we sold them, we used the money to pay off all the liabilities, money we owe other people. Whatever we have left over is what we call owner's equity, the equity that the owner has in the business. So our accounting equation, or our assets, the dollar value of our assets, equals the money that we owe other people plus the equity that we have in the business. That is the accounting equation. Now, assets are resources that are presently owned by a business that generate future economic benefits. So, in our farm example, we have a farm, we have a barn, we have a tractor, we have a truck. We can use those resources that we own to help us make money. That is the definition of an asset. A liability is simply the amounts that we owe other people, that a business owes other people. And owner's equity is the amount invested and reinvested in the company by its owners. So we said we had some money to start with that we put of our own pocket, of our own hard-earned effort into the business, but we also borrowed some from the bank. So that is the amount invested in the business. The amount reinvested in a business is once our business is up and running. So how do we increase the amount of equity that we have in the business? Well, there are two ways we can do it. We can insert or invest more money into our business. But the best way to do that, if you're a business owner, is to make a profit. And in order to make a profit, we need to generate some revenue. We need to plant our seeds, grow the crops, harvest them, and sell them. Generate some money. By doing that, and in order to do that, we're going to have to incur some expenses. We're going to have to pay for the seeds. We're going to have to pay for fuel for the tractors and the trucks and all these other things that we need to run and operate our business. So we're going to incur some expenses. However much revenue we have, minus the expenses that we have, is whatever's left over is what we call net income. So in order to increase the equity that you have in the business, you can add more money or you can make a profit. Much better to make a profit if you're trying to make a better business. So that's just an overview of the accounting equation. We'll talk about the details more specifically, but this is a good introduction.